Do you also believe that you need a lot of money for investing? Well, you are not the only one. Many people they delay investing, including a lot of students, for exactly the same reason. And I have personally met a lot of people who say, I'll start once I'll have a job or I will wait until the market looks safer. But let me tell you something. There's no perfect amount of money to start with, and there is no perfect time to enter the market. And from my personal experience, your first $100 can be the real game changer. It may not change your financial situation, but it teaches you how an investment account exactly works, how market movements feel when you are invested in that, and most importantly, how to build the long-term habit of investing. I started my own investing journey back in 2021 when I started my PhD. And in this video, I'll show you how I started investing, what I learned from my experience, what risk beginners should avoid, and how a small start can eventually become a long-term investing system. So before investing any money, the first question which we need to ask whether that money should be invested at all or not. Am I going to need that money in the next few years? And if there is a good chance that I'm going to need that money, so the stock market might not be the right place for it. Because nobody knows what is going to happen to the stock market in the next few years. So your investment time horizon and your ability to tolerate risks are important when deciding how much money should be invested in stocks. And for money that I would need in next few days or few months, I personally would not depend on. So if you invest only $100 and never invest another dollar for the next 50 years, that alone is not probably going to make you rich. That $100 is more than enough to start learning how investing actually works. Now I'm gonna break it down into different parts, starting with step 1, build the financial base. So one thing which I have always tried to make sure of that all my necessary bills are covered before I put any money into investing. And on top of that, you should have some emergency savings as well. The exact amount will differ for different person because everyone's expenses and financial situations are different. The important point is that we should not invest money that we may need in next few weeks or next few months or in a year. And borrowing money at a high interest rate just to invest in stock does not make any sense and should be completely avoided. Every investment involves some degree of risk, and stocks can lose value as well. So when you start your investing journey, starting responsibly is much more important than starting quickly. And that leads us to how to start. What is the right account for that? Now suppose that you have $100 to invest, which you are not going to use in next few years. The obvious question is, how do you actually invest it? For example, you may have access to your workplace retirement accounts such as 401k and IRA or regular taxable brokerage account. Each type of account can have different tax rule, withdrawal rules, eligibility requirement and contribution limits. We are not going into retirement accounts in this video because that deserves a separate discussion alone. For the rest of this video, I'm going to focus on regular taxable brokerage account because that is where I personally started my investing journey in 2021. I personally started with Robinhood and many of my friends used it as well. But there is no single brokerage platform that is perfect for everyone. The correct choice depends on what features you need, the fees involved, and the investments available and your personal financial situation. Moving on to step 3, understand fractional shares. One question people often ask me, how can I start with only $100? This is where fractional shares become useful. A fractional share simply means that you own less than one full share of any company. For example, Apple is currently trading around $300 per share. So if your brokerage allows fractional investing, $100 could buy you approximately 1/3 of Apple share. But there is another very important lesson here. The price of one share does not tell you whether a company is cheap or expensive. A stock trading at $500 share can have a cheaper valuation than a stock trading just at $20 share. So in simple words, share price and company valuation are two completely different things. The valuation of a business matter much more than simply looking at the dollar price of one share. Moving on to step 4, that is ETF. So when I first started investing, I did not know how to properly analyze individual businesses. I did not know how to read all these financial numbers of different companies or determine whether a stock was fairly valued or not. So as a beginner, it can become overwhelming very quickly. So one of the simpler ways to get exposure to many companies at once is through an ETF. And ETF stands for exchange traded fund. So an ETF is an investment fund that trades on exchange and can hold many different companies all together. For example, very famous one, S&P 500. So this S&P 500 includes the biggest 500 US companies. So if you invest $100 in S&P 500, all your $100 will go towards 500 biggest companies, and your $100 will be broken down into different percentages of these companies. For example, if Apple consists of 1% in this ETF, so when you invest $100, your 1% of money will go to Apple share. So this allows that instead of depending entirely on the performance of one company or few companies, an ETF like S&P 500 can give you exposure to 500 biggest companies in the US. Why can that be useful to you? Suppose your entire portfolio is just dependent on two companies, and if one of these companies perform very badly, your portfolio will go down a lot. So diversification spreads your investment across more companies, although it does not eliminate the possibility of losing money when the overall stock market falls. Another advantage of ETF for a beginner is that you can spend more time building the habit of consistently investing instead of consistently trying to find the next popular stock. But remember this, an ETF can also fall. Diversification reduces companies' specific risk. It does not remove stock market risk. That is exactly why I said earlier that money which you may need in the next few years should not be invested in the stock market. And moving on to what if you want to buy individual stock? So once people become more familiar and comfortable with investing, many becomes interested in individual companies. And I understand why. Historically, S&P 500 has created significant wealth over long term. So if you see S&P 500 from 1928 to 2025, S&P 500 has given a return of around 10% per year for that period of time. But that does not mean that market has returned 10% every year. Some years produce very strong positive returns, whereas some years it gave major losses. So individual stocks can produce returns far above the overall market during certain period. But the risk can also be much higher because your money is concentrated in fewer businesses. So I personally have invested in individual companies, but before I try to invest in any company, I try to understand few basic fundamentals of those businesses. And I generally try to see these points. How does that company makes money? For example, Apple. Are revenue and profits of Apple growing? How much debt the Apple company has? Does the business generate free cash flow? And at the same time, the company can be growing while its financial position is weak. So that is why I look at both businesses and the valuation. So your first 100 can be part of this learning process. The purpose is to learn these lessons while the stakes are still small, instead of learning them after much more money is involved. Moving on to part 6, what is the action plan for that $100? So at this point, you might actually feel more confused. But hopefully you are less confused than I was when I started. So let's make it very simple. First, decide the purpose of that money. Means how long are you planning to invest that money? So for my own investing, so I try to separate ETFs versus individual companies. So here is how I invest $100. So if I have to start again, my first $50 will go to ETF. The remaining $50 will go to individual companies. And personally, I would put around 50% of my individual allocated fund to bigger companies like large cap companies, and then 30% to mid cap companies, and then 20% to smaller cap companies. So large cap companies will be stable and will generate lower return versus mid cap and smaller cap. However, mid cap and smaller cap can generate more return, but it will be more unstable. So from that $50 for individual company, $25 will go to large cap companies, $15 will go to mid-sized companies, and $10 will go to smaller companies which have higher risk. So companies such as Apple, Microsoft, Nvidia, Alphabet, Amazon are examples of well-established large cap companies, but that does not automatically make any of them a good investment at today's valuation. The S&P 500 has currently listed these companies among its largest constituents. And remember that market cap classification changes as the stock price and company's valuation changes every day, even every minute. So the purpose of this $100, now you understand that to create a portfolio for learning purpose. The purpose is to start now. And this approach also helped me to focus less on what the stock market might do tomorrow, next month, or next year. Moving on to part 7, that is traps to avoid. By now, you should have better understanding of how someone can start investing with a small amount of money. But there are also some traps that beginners should be very careful about. Number 1 is frequently trading which is buying and selling very repeatedly, that can tempt you to treat investing like a game rather than ownership or business. You can also create additional trading costs, taxable events, and emotional decisions. So personally, I prefer to think in a long-term direction, and I have never done day trading or options trading. Trap 2, using leverage or options before understanding the risk. So the risk, borrowed money and short-term options can magnify losses very quickly. So if you don't understand something, stay away from them. You might be seeing in short videos that people had made 100x return in few days. That also means that there is a 100x of risk as well. Number 3 is chasing the lottery ticket stock. When someone has only $100, it can be tempting to think, I need to find the next stock that will go up 10x soon. But that mindset can turn investing into gambling. So your goal should not be to become rich from one trade. Your goal should be to build a system that can create wealth over a long period of time. And that leads us to part 8, how the habit can grow. So now let me show you why the habit becomes more important the first $100. So instead of randomly assuming an 8% return or 15% return, let us use actual historical number of S&P 500. So historical data compiled by Professor Aswad Damodaram at NYU shows that $100 invested in S&P 500 at the beginning of 1928 with dividends including would have grown to approximately $1.16 million by the end of 2025. It works out to an annualized compound return of approximately 10% over 98 years. But 98 is a very long period of time. So let's try to see for 30 to 40 years. Suppose someone invested $100 every month and the investment hypothetically compound at the same rate of return, that is 10%. So after 10 years, approximately that money would be $20,000 and your total contribution would be $12,000. After 20 years, approximately $72,000. Total amount contributed, only $24,000. After 30 years, almost $207,000. Total amount contributed is only $36,000. And after 40 years, $558,000. Total amount contributed is only $48,000. These numbers are not predictions. The stock market does not give you 10% return every year. So you have to see the ups and downs of the market as well. The actual result would depend on when you invest in the market, market performance, taxes, fees, inflation, and all. So do not look at the final number of $558,000 after 40 years. Over long periods, regular contribution and compounding can become much more important than the size of your first investment. So your first $100 starts the habit, the next $100 continues it, and eventually the habit becomes your system. So if you decide that you want to study individual stocks, you can use the stocks school to start learning about the businesses. Look at the company's business model, financial history, cash flow, debt, valuation, and major risks. Let me clarify here. This website does not simply list stocks to buy or sell. However, it can give you the basic understanding about any company. Use it as an educational tool to understand why one business may be stronger, weaker, cheaper, or more expensive or riskier than the other one. And remember that the goal of your first $100 is not to prove that you are a great investor. The goal is to become a better investor before much more money is involved.